Hello, I'm Ryan Lightfoot-Amanoff of Kepler Trust Intelligence, and welcome back to our month-long series of videos in the run-up to the ISA deadline. So far this week, we've been looking at sectors that have been somewhat under the cosh, but are arguably due a recovery. Today, we look east towards one of the most high-profile sectors facing headwinds, China. We will soon hear from Sophie Earnshaw, manager of the Baillie Gifford China Growth Trust, who will put forward the case that China has more to gain from good relations with the West than from its eternal pariah status, and therefore must eventually come in from the cold. For those of you who haven't tuned in yet this week, the format is that Sophie will talk for approximately 30 minutes before handing over for 15 minutes of Q&A. If you would like to put any questions to her, please use the Q&A function in the chat, where we will collate them all and put them to Sophie at the end. Now, without any further ado, Sophie, please take it away.
Hi there. Thank you, everyone. Thank you for joining us for this session on China Doom or Bloom. So as Ryan said, I'm Sophie Earnshaw. I'm one of the co-managers on Baillie Gifford's China Growth Trust. So let's begin with some context. 2023 was obviously a very disappointing and painful year for Chinese equities, with our index falling by 30%. Indeed, this marked an unprecedented third consecutive year of drawdowns in our asset class. Now, the only sector in positive territory over the year was the energy sector, which posted around a 17% return. The next best sector was utilities, which fell around 9%, followed by financials at negative 15% return. All other sectors delivered even greater negative returns. Short-term investors, faced with mixed economic data and disappointing levels of policy support, moved into defensive sectors and state-owned enterprises. So if you look at the FTSE China SOE index, for example, this outperformed the non-SOE index by around 12% in 2023, continuing a trend that began in 2022. Geopolitics was also a negative driver, with technological controls and economic barriers increasing, even as relations between the US and China formally stabilized. December actually marked the worst net outflows of China-Hong Kong equities in 2023, and the third largest monthly outflows in history. Foreign investors appear to be increasingly shunning China. Indeed, third quarter data indicated that foreign direct investment fell close to negative territory for the first time since 1998. So clearly, really remarkably awful year for China. But where does this leave us? So in absolute and relative terms, the valuation of Chinese equities is now demonstrably low. Our benchmark MSCI China All Shares is trading on around 9 times 2024 price earnings. This multiple is less than half that of US equities, and below that of both MSCI ACWI, which is around 17 times, and emerging markets, which is on around 12. So a huge amount of macro doom. But what about at the micro level? Well, if we take our trust portfolio as an example, our companies continue to grow. So indeed, our portfolio holdings delivered around 18% earnings growth last year. That's roughly 9-fold greater than the rate of the benchmark, which only delivered around 2% growth. So a demonstrable micro bloom within our trust portfolio. And then at the Baillie Gifford level, where, as you know, our focus is on finding and holding the very best growth companies over the long run, we continue to find that China is an attractive source of micro investment ideas. So for us, China's still the largest and perhaps most dynamic investable universe outside of the US for many of our strategies. Its lead in areas such as renewable energy is remarkable. Its industrial players are quickly climbing up the global value chain. Its consumer base is also getting richer, and this demand matters, not just for Chinese brands, but for global brands. So these are long-term structural trends that continue to create what we call micro blooms at company level. And that's really what gets us excited as stock pickers. However, this isn't to deny China's macro challenges. And as investors in China are obviously acutely aware, it's these challenges that have dominated returns over the last, not just the last year, but over the last 3 years. And the challenges are probably threefold. So regulation, the economy, and geopolitics. So let's take each of these in turn. Regulation. So since the crackdown on the internet and education sectors in 2021, many Western investors have concluded that Chinese regulators and the government itself are capricious and averse to the private sector. Now, for some, this makes the potential rewards of investing in China actually no longer worth the risk. Now, for us, we don't think this sort of broad brush statement is helpful. The real question for us is, how do we make sense of the system that Chinese businesses operate? How do we navigate it successfully? Now, on the one hand, the scale of China's domestic market, its dynamic entrepreneurial culture, combined with, I think, bold, top-down, and typically supportive industrial policies, does provide formidable advantages in producing great companies. On the other hand, the speed of development in China can present challenges to the government and to regulators. So to pick one example, it only took a few years for WeChat Pay to grow to 1 billion payment transactions every day. Apple Pay still only processes 1 billion transactions per month. But let's think about the context here. This is in the context of America's antitrust law, which has been in existence for more than 100 years, versus China's antitrust law, which only was established in 2007. So regulation has typically lagged innovation in China. And the process of catching up, plus China's top-down system of government, means that communication has been handled poorly. Now, this is unlikely to change meaningfully in the short term. But what has changed, we think, is the government's willingness to roll back regulation that isn't helpful. So we saw this recently with the gaming sector. At noon on the Friday before Christmas, regulators proposed restrictive new rules for video games. With almost no market liquidity, share prices for gaming giants Tencent and NetEase fell sharply. Then on the next day, perhaps recognizing the damage, policymakers reversed course. The official responsible for the proposal was then removed. The policy has since been shelved. And on top of that, a few hundred new gaming licenses were approved. So we've long been discussing the sort of pendulum nature of China's regulation, where the balance between the state and the market becomes unstable, causing periods of volatility. Now, while determining what's cyclical and what's structural isn't easy, one thing has become clearer than ever for us, and that is that it's vital to focus on areas where public policy and profit motives are aligned. And here, we think the private sector and the companies that we own in the main within our portfolios have one very important factor in their favor. And that is that the private sector generates up to 50% of tax revenue, 60% of GDP, 70% of technological innovation, and 80% of urban employment. So in short, the government needs a healthy private sector if it is to deliver on its promises to the Chinese people. Now, geopolitics. Although relations between China and the US have formally stabilized and dialogue has been reestablished, we think we should expect geopolitics to remain a longer-term headwind. The question really here is, how do we price this in? Well, as I noted earlier, valuations for Chinese equities do appear very low relative to history. and to the opportunity set on offer. And we're also finding this at the company level too. So even for those companies with almost zero revenue overseas, Meituan, for example, an overwhelmingly domestic growth opportunity, growing its top line at 20% per annum. It's been derated along with the rest of the market, in line with all of these geopolitical issues, now trading on less than 15 times. Or taking the China Trust portfolio as an example, 85% of our revenue within the China Trust portfolio is exposed to domestic China. And as I said earlier, that portfolio grew its earnings by 18% last year. But that share price, that operational performance wasn't rewarded with share price growth. In fact, the portfolio derated from 19 times to 12. Moving on to the economy. Now, China's economy has been weak, but it's not in crisis. So GDP grew by around 5.2% in 2023, and the country met the official growth target for the year. Now, the International Monetary Fund does expect growth to slow in 2024, but only to I think, still reasonable 4.6%. Now, whilst the property market's drag on nominal growth continues, other segments of the Chinese economy, namely household consumption and exports, have been strong enough so far to offset this weakness. With regard to property, I think context here is important. The government's long-term aim is to reduce the country's reliance on this sector as an engine of growth. And most Western economists would agree that this adjustment is necessary for the country's long-term economic health. Now, with this in mind, the government's refusal to stimulate aggressively and provide a quick fix becomes a lot more understandable. But the government are trying to stabilize the market. And more broadly, we do think that we appear to be in the midst of something of a course correction by the Chinese government, which is increasingly turning its attention to the most distressed segments within the property industry. Now, any stabilization here could be very meaningful for consumer confidence, which could in turn be very meaningful for domestic demand. So consumers in China are sitting on an estimated $7 trillion of excess savings, and it's perhaps only a matter of time before this is put to work. In addition, Beijing appears to be attempting to put a floor under the equity market after, as I said earlier, an unprecedented 3 years of continuous declines and significant outflows by foreign investors. So in February 2024, in response to the stock market rout, we saw Beijing begin to intervene in the equity market via the purchase of stock index funds and SOE buybacks. We also saw the former head of the China Securities Regulatory Commission replaced by an industry veteran. All positive signals, we think. But saying that, we've never been investors in China's GDP growth story, nor do we consider the index as a good representation of the growth potential of Chinese companies. So when looking at historical returns versus GDP growth or any other macro indicators, among EM countries, China is actually a significant outlier in the sense that China's equity market return has very little correlation in the long run with macro factors. And focusing only on the macro picture can distract investors from what really matters to companies and to their returns over the long term, which is operational performance. Now, we also think that the index is quite a dangerous place to hide. So if you look at MSCI China, for example, nearly 1/3 of that index is occupied by state-owned enterprises, which in aggregate tend to deliver lower than average growth and have variable sort of corporate governance. But there are companies out there, a huge number of them, left-hand side of this pie chart, which are privately run, involved in the new structural growth themes that are largely independent of overall GDP growth. And this is really what we focus on. Our aim is to find these companies who could travel from the left-hand side of that pie chart to the right-hand side, thereby becoming the next sort of generation's giants. Now, one of our US clients recently told us that China only accounts for a tiny proportion of their asset allocation, but it dominates discussions. And here I think it is worth remembering that there is a big contrast between how much China matters from an economic perspective and how little it is represented in most people's investment portfolios. So the whole Chinese equity market accounts for a 3% weight in MSCI World Index. That's actually less than one single US stock, Apple. Now, within the same index, China accounts for around 40% of companies that are forecast to grow revenue at 20% for the next 20% per annum for the next 3 years. So this again, we think shows quite a persistent gap between the sort of perceived kind of macro doom and the hidden sort of micro bloom that we see in China. And it's the latter where we remain committed and where we think the hunting ground remains very rich. Now, China has proved itself far more innovative than many believed was possible. So up until recently, China was seen as a copycat or as a low-cost manufacturer. However, this is changing. Massive R&D, bold long-term industrial policies, combined with a massive domestic market, have earned China leading positions in many modern industries. Now, the change this innovation brings is stark. Now, the hometown of one of my colleagues is a small coastal city in China. I think this anecdote illustrates this point quite well. When she visited home last year, that was the first time she'd been home since the pandemic. And a significant amount of change had occurred. So for the first time, she saw that half the taxis on the street had green license plates, meaning that they're electric cars rather than blue plates for combustion cars. She found that WeChat had become basically her own mini personal assistant. So on top of texting or payments, WeChat's mini programs helped her fill in customs declaration forms, book local classes at the gym, apply for a bank account, speak to her doctor online to get a prescription. And when she came back to us in the office in Edinburgh, she talked about how she wished that some of the apps in the UK had this utility. The changes are happening fast on the ground. Another couple of examples. China has built now more than 70% of the world's solar and battery capacity. It's really a leader in renewable energy capacity, but also renewable energy technology. BYD, a Chinese EV automotive company, a new holding within our trust portfolio, has just surpassed Tesla, recently becoming the biggest EV seller in the world. Now, if BYD's founder is right, in the next 5 years, 90% of new car sales in China could be EVs. Or another example, 10 years ago, many doubted China's ability to catch up in 4G. But China now has more 5G stations than the rest of the world combined. And then when it comes to private companies, the country is now home to many more unicorns. In fact, in terms of the number of unicorns, it's second only to the US. So the opportunity set in China continues to broaden. Now, the Chinese Trinity 5 to 10 years ago was really BAT, Tencent, Alibaba, and Baidu, in search, e-commerce, and social. And while this theme continues to play out, there's a new trinity of companies, of opportunities, batteries, EV, solar, BES, also emerging. And in addition to that, so many other hidden gems basically embedded in China's vast industrial chain. Now, to be able to take advantage of this requires quite a different pair of lenses for investing than those we apply for developed markets. And whilst the risk premium attached to China has gone up, given regulatory and geopolitical challenges, we acknowledge that we do need higher reward now to offset the risk. I mean, this is tougher when speaking only about China's macroeconomy and politics, but it's far easier to justify that reward, to find that reward to offset that risk when you're focused solely on the bottom up, looking at companies on a company by company basis and their phenomenal growth opportunities ahead of them. Now, there are more than 5,000 listed Chinese companies. Across all our Baillie Gifford strategies, we invest in less than 100. It's clear to us that active selection will matter more when China's aggregate growth slows down. Now, the bar of owning Chinese companies is higher, but we think we should resist the temptation of making that broad brush conclusion based solely on the macro risks. More importantly, for us as active managers, China continues to provide an exciting hunting ground for growth-oriented stock pickers. And while the overall macroeconomic environment may continue to be sluggish, there are significant structural opportunities in a wide variety of industries. So for us, the opportunity set really does remain rich and compelling, and the quality of the best listed companies in China continues to surprise us positively. So within our trust portfolio, we own around 60 of the very best of these opportunities. And we have a portfolio that's significantly different to the benchmark as a result. Now, the prices we're being asked to pay for these opportunities, in some cases, haven't been seen for years. And of course, there is a non-zero risk that China becomes effectively uninvestable for many market participants, and that we're left with a portfolio of companies potentially on sort of one times earnings growing at sort of 20-30%. But there's also a significant non-zero risk that domestically things materially improve from here, that extreme levels of pessimism on the asset class moderate somewhat, and that pools of capital, out with developed markets become meaningfully invested in the China story. As such, this remains a market with significant risks and opportunities, but one that we remain continually excited about at Baillie Gifford. So I'll stop there, Ryan, and open for Q&A.
Thank you very much. That is very interesting. It certainly gives us lots to talk about. We have had a few questions come in. I think one of them, we'll probably start with this one just because of where we are in the slides. One of the big sort of structural growth themes, especially in the West, has been AI. How does this sort of feature in your portfolio?
Yeah, so in our portfolio, AI it's been a little bit tricky within China. So on the one hand, you can invest in sort of AI related themes via sort of semiconductor companies. So out with China, it would be companies like TSMC that are sort of manufacturing the chips that are sort of powering AI. Within China, it would be companies such as SMIC, for example. In the semiconductor manufacturing part of the market, this part of the market is dominated by state-owned enterprises, and within that part of the market, we aren't finding that sweet spot between alignment with government aims. Clearly, there's a big tick there. China really wants to move up the value chain in semiconductors. But that alignment between sort of government aims and then profit motive. And I think it's profit motive where these companies fall down. They are really there to advance sort of China's national aims rather than to make sort of profits for minority or any shareholders. And as such, we sort of avoided that space so far within China. The other sort of area would be in sort of analog semiconductor chips. This is where we do have some exposure, but this is lagging edge technology. And here the story isn't really about AI, it's more about China's domestic companies sort of moving up the value chain in this lagging edge technology and taking share from developed market competitors, such as sort of Texas Instruments that sort of dominate this market. So unfortunately, in our China portfolio, we haven't been able, we don't have a lot of exposure to sort of direct AI. Yeah, I'll stop there.
No, that's all good, thank you. A couple of questions sort of related to that and some of the sector exposure as well. You talked at the top about some of the sort of challenges and opportunities from regulatory oversight. Do you think that with you potentially looking at some of the opportunities from there, creating sort of moats around industries, that would begin to affect your SOE exposure or allocations at all?
So with regard to SOEs, as I said, you know, the SOEs within the market have performed much better than private companies over the last 1 and 2 years. And part of that is because investors in this sort of weaker macroeconomic environment have been hiding within a lot of the stodgier kind of state-owned companies that are very low growth but pay a very high dividend. On top of that, you've had the government trying to reform the SOE sector. And there, I think we may be able to find some interesting opportunities. A lot of, in aggregate, we don't have a lot of exposure to SOEs because, you know, they're typically lower growth and they typically have sort of variable corporate governance. But there are some that we have exposure to. So, for example, Guizhou Maotai, which is, I think, one of the best sort of SOEs, I think the best SOE in China, and probably has the strongest brand within the whole Chinese market. Or Zijin Mining, which is really sort of enabling the green transition. And then out with that, we are doing some work on the sort of SOE opportunity set to see that, to make sure that we're not missing anything. But so far, the stocks that we've looked at, we haven't been able to get over the hurdle of both growth, outlook, and sort of quality alignment. Yeah.
That makes sense, thank you. Sort of we'll come back to that a little bit actually. We're just going to do one more on sector. Just one of the areas you use, well, we can see up there is sort of the automotive sector, with BYD overtaking Tesla on EV ownerships. What are the prospects for the sector in China, and how much are you allocating towards it?
Yeah. So the context here is that you know, EV penetration in China in terms of new car sales is around 35%. But some market participants think that this is growing very quickly, and some founders, as I said, think that this could go to 90% in the next sort of 5 to 10 years. As you know, in Norway, we're already at sort of 90% EV penetration. So there's a sort of structural growth tailwind there for EV auto manufacturers. At the same time, the auto market within China is incredibly competitive. We're seeing a huge amount of sort of price competition at the moment. So our exposure there in aggregate is quite limited because of this very sort of strong competitive environment. But we have just bought a new holding in BYD. We like BYD because of its vertical integration, which we think gives it a significant advantage, particularly in an industry that is so competitive, particularly cost competitive. So they have a cost advantage because of that vertical integration, and they have an iteration advantage. So the speed at which they come up with new models, new cars, is much quicker than some of their competitors that have to source externally batteries and all of the key components that go into the car. So we think BYD's sort of vertical integration is a significant advantage and should mean that it emerges as a sort of long-term winner. And then on top of that, the icing on the cake may be that they might be able to grow volumes somewhat overseas. Obviously not in the US market, which is effectively closed, I think, to Chinese EV manufacturers, but potentially in other emerging markets or at the margin in Europe.
Great, thank you. And a couple of sort of broader questions on China economy and valuations as well. I'll try and put them all together. You said at the top, this is the third negative year for the China. Is that sort of unprecedented in modern history? Is that pointing to a potential recovery? How long do we think that recovery will take to come, and will it get back to where it was pre-pandemic, because some of this is post-pandemic? And then just sort of broadly on valuations, there's a lot of questions bundled in together. The valuations are considerably cheaper than their averages because of this weakness. Do you think that could be sustained? And if not, how much recovery is there in there?
Yeah. So in terms of our index MSCI China All Shares, yeah, it's the third consecutive year of drawdowns. That is unprecedented in the index's history. And a lot of that drawdown, I think, is because returns in the market have been dominated really by sort of macro economic factors and sort of geopolitics. As I sort of tried to allude to in the presentation, it's always very, very difficult to sort of decide when you think a turning point is coming. But what I can observe is that as I said, the government does appear to be gradually trying to stimulate, trying to really address those very severe pockets of weakness, particularly in property. So, there initially we had a lot of demand side stabilization measures put in place. That was sort of in the beginning of sort of 2023. We've seen mortgage rates fall to the lowest on record and restrictions on purchasing removed, but those measures didn't have much success. So in the second half of 2023, we saw the government announce an increase in public sector construction spending via what they're calling the three major projects. So the expansion of social housing, renovation of urban villages, and construction of sort of civil infrastructure. That started to help, I think, at the margin, but didn't really move the needle. And so again, then in January 2024, we saw the government move to begin to extend support to the private sector developments. And they're really the most distressed subsegment of the industry. So measures there include things like priority sector lending from the PBOC, additional credit support promised from banks, and then local governments in 8 cities beginning pilot projects to buy up vacant apartments from developers to reduce inventory and help stabilize cash flows. And I think all this is important because it feeds into consumer confidence, which has also been very, very weak. China's pre-sale housing model is one that, when the consumer loses confidence in those private sector developers, they stop being willing to buy property, and property is where a lot of sort of people's wealth is tied up. So any stabilization or improvement in confidence in those private sector developers could, I think, be really significant, both for just sort of GDP overall, sort of China's growth, but then also for the consumer. And I think, as I said, the consumers have money to spend. They're sitting on excess savings of around $7 trillion when the entire sort of A-share market is, I think, worth around 10 trillion. So, these numbers are not insignificant. And when they are put to work, we should see, a significant recovery. And then, we're in the context where we are now. We have just had 3 years of consecutive declines. We have had significant outflows of foreign investors, FDI going negative for the first time since 1998, and valuations looking, very, very low. So, there's always 100% downside, but, risk reward, I would say, is probably skewed now towards upwards, if you will.
Yeah, that makes sense. Thank you. And with some of those sort of cash piles that you said are available and sitting on retail balance sheets, do you think this could lead to an increase in demand from retail investors towards Chinese equities? I know in the past it's been sort of treated a bit like a gambling rather than investing, but do you think that could change with some of these policies coming in?
In the long run, I mean, the government's aim is to try and sort of diversify where the Chinese consumer is storing its wealth. So sort of out of property and into other sort of areas, such as, for example, the stock market. And I did think it was significant in February 2024. So this is all, we've had this horrible year. And this is all coming sort of January, February of this year. Another indicator, I think, of the government's kind of course correction. In February 2024, we had Beijing begin to intervene in the equity market via, as I said, the purchase of these stock index funds and via sort of SOE buybacks. And we did have the head of the security market regulator replaced. And I think, the government are trying to shore up the stock market as a sort of alternative for wealth creation. So in the long run, yes, I think we will see a move out of property into other areas, and the stock market would be one of those. But the timing is again the key question.
Yep, fair enough. Thank you. Take sort of a step up a little bit, looking at some of the more macro big theme pictures. One very topical one at the moment, obviously we had Super Tuesday last night in America, strong potential now of Donald Trump becoming president. Do you think that could see an increase in some of the trade or investment restrictions, or is that not really affecting what you're doing with sort of the micro level?
So as I said, so 85% of the trust portfolio's revenue is domestic China. And we've got that 15% that is overseas. I think around five, if my memory serves correctly, I think around 5% is to the US. And we have it's very unclear as to what sort of Donald Trump would do if he becomes president, but we have heard sort of rumors of potentially 60% tariffs on some Chinese goods. So I think there's always the risk that tariffs will increase further. But for us, the companies that we invest in, it's very, very rare that you hear a company say, we really think the US is a fantastic growth opportunity for us. They just don't think that anymore. So and any companies that do have significant US revenue, what we've been doing over the past 3-4 years is in our valuation, when we come back and we look at the fundamentals of the companies that we invest in, looking at the valuation, basically writing off that US revenue, just assuming that goes to zero, and then saying, okay, from that level, could we see a doubling in the shares and the operational performance? And if we can't, then we've typically sold the stock. And if we can, then we'll tend to hold on.
That makes sense. Thank you. Also, while we're sort of on the top level, lots of investors and lots of people we talk up India as the new China. But what advantages does China still have over India, and can these be sustained?
I think China and India are just in very sort of different places in their kind of GDP or sort of development model. So for China, the question is really, can it continue to move up the value chain? Can it continue to innovate? Can it put through those productivity gains when it has got an aging population? Can its companies continue to sort of develop into leaders, not just in a sort of EM context, but in a global context? Whereas for India, we're just much earlier in sort of India's sort of development or stage of growth. It's much more about becoming a sort of middle income country rather than moving up from there. So I think they're just very different, and I'm not sure I'd sort of put them side by side necessarily. I do think that I think one of the advantages that China has is that it is domestically an incredibly competitive market, much more competitive than India. So it's an anomaly. China is a communist country, but it's incredibly capitalist in terms of the competition that the companies are forced to survive. And that leads to these companies in China generally being remarkably good, remarkably competitive. Competitive not just in an EM context, but globally. And whereas I think in India, you can get by being sort of mediocre, but having a sort of niche. So that's one sort of difference that I draw. But again, I wouldn't necessarily sort of compare them as such. I think you can probably make money by investing in the sort of Indian story, although valuations there are much, much higher than they are in China. And I think you can make money by investing in China, but for, for different reasons.
No, that's interesting. Thank you. Um, and with sort of China and the government focusing on sort of that domestic consumption and building up the consumer, where does this leave things like the Belt and Road Initiative? Are they going to sort of sack that off and refocus on the country itself?
Um, yeah, I don't think they'll sack off the Belt and Road Initiative, but they might. I think that it's still sort of they are still investing there, and they still hope to, develop, or I guess develop other trading partners outside of sort of developed markets. Actually, interestingly, China's trade with Asia, other Asian countries, is now greater than I think the trade between the US and Europe. So that they whilst trade barriers are sort of going up with sort of the US and to a certain extent Europe, actually trade with the rest of the world for China is flourishing, which is a positive. So I mean, Belt and Road, I think that will continue, but um, I think it probably was a little bit over emphasized, or at least it has been over emphasized in the Western press. I think the real goal of the Chinese government is really domestic. It is really focused on improving the lives, on improving sort of the wealth per capita of individual people in China, and that has to be the primary goal. Without success there, you don't get success anywhere else.
Mm. Oh, good, thank you. And then again, from a sort of country level and looking at it with sort of an Asia Pacific lens, lots of investors who can invest across the region are increasingly considering Hong Kong and China as basically just one country exposure. Where do
Mm.
you see the line there? Do you differentiate much between those companies, and especially in terms of governance, which I know is a big factor for you?
In terms of sort of Hong Kong versus China,
Yeah,
or yeah, um, so I mean, Hong Kong, the companies listed in Hong Kong, there's a sort of odd mix. There's kind of developed market Hong Kong that sort of, companies kind of investing in Hong Kong or in the broader region. And then there are those Chinese companies listed in Hong Kong that are basically Chinese companies, like a Tencent, that have, the majority of their revenue and assets in China, and that their growth is dependent on domestic China. So, um, but if it's, I'm not sure, is the question more sort of versus the A-share market and Hong Kong, or?
it's just where your sort of preference lies in terms of Hong Kong and China. Do you consider anything in Hong Kong as basically China?
Yeah, so for us, we're trying to invest in the best Chinese companies regardless of listing location. So it doesn't matter for us if the company is listed in the Asia market versus in Hong Kong versus in the US. It's really, does that company have a competitive edge? Does the majority of its revenue and profits come from China? Then it's really a Chinese company, and then listing location is sort of a secondary kind of consideration. At the margin, you do get, I think, better. This is very much at the margin, but you can get better protection if you're investing, for example, in an A-share company via something called Hong Kong Connect, which is you invest via Hong Kong Connect into an A-share company versus directly investing in the A-share company itself via something called QFI. But this is, so the margin, there are these sort of governance or protection differences, but these are very much at the margin.
Okay. And then I think, well, the final question that we've got here, but by all means, audience, you're very welcome to keep chiming in. Going back to valuations again, they are considerably lower than average. Do you think that their valuations are fairly reflecting some of the concerns that people have over the challenges that China faces, or do you think that actually these are very cheap versus historic levels?
Um, I think it is cheap versus historic levels, but I think it's right that I think it's right that the risk premium has gone up on China. There are these sort of, in the short term, these kind of esoteric risks to the asset class. I think it makes much more sense to look at it on a sort of company by company basis. And, here, so if you've got a company like, for example, CATL, the world's largest EV battery manufacturer, growing at sort of 35-40% per annum, but trading on sort of 10 times earnings, that I think is an example of a company or of an investment where it's just too cheap. If you look at, for example, some of the SOE companies within China that aren't really growing that much, but are on a similar multiple, then I'd say no, I think they're sort of too expensive. I think for our portfolio of stocks, as I said, the China Trust portfolio, it grew earnings 18% last year. It derated from 19 times to 12 times. I think our portfolio itself looks very good value at the moment. But I do like to caveat all of these comments with just the basics, that there is always 100% downside. So, only invest if you have sort of the appropriate kind of risk tolerance and also volatility tolerance, because China is, at the end of the day, an emerging market, and it can be much more volatile, particularly in the short term, over other asset classes.
Very well put. Well, I think we've reached our time for today's session, so we'll draw things to a close there. It just leaves me to say thank you, everybody, for watching and listening. Thank you to Sophie for your time. Very insightful look into China and what's going on. It's a real food for thought, so thank you. And if anyone would like to listen back to Sophie's presentation, a recording will go live on the website in the next couple of days. We are continuing with our series, so we're taking a short break tomorrow, but we'll be back on Friday where we revisit the opportunity within the UK with Sue Nofka's Schroeder Income Growth Trust. So until then, thank you very much and goodbye.